You know that I'm an active real estate investor with direct ownership of individual income properties, but at times I like to invest in funds too, because they give me the benefit of a tangibly backed asset that's harder if I wanted to access that myself. So today I'm willing to share with you exactly where I invest my own fund dollars, and that is through Danny Lynn Robeson at Freedom Capital Investments. Danny Lynn, welcome back.
Thank you so much, Keith. I appreciate you having me on again.
Fund is one of those, I think it's like a 4-letter word in some investing circles. But like I brought up the point before, Danny, that much like debt and loan are 4-letter words, like bad words in some circles, you know, once you learn about true wealth creation, oftentimes things like debt and loan are real assets to wealth creation. It's almost impossible to build it without them. And fund is actually one of those good investor 4-letter words too, if you will. So I think just starting at the beginning, what is a fund?
Yeah, so a fund is a pool of money and it's allocated for a specific purpose. So let me explain that a little bit. A fund could be a pool of money that invests in multifamily properties. It could be a pool of money that invests in self-storage facilities. It could be a pool of money that invests in both of those and maybe 2 other asset classes. But it is a group of money where people can invest and know exactly where those funds are being invested.
So we're getting somewhat more of a diversified element than we would with, say, a syndication. Now, I think of a real estate syndication as typically investing in just one asset, like a 250-unit apartment building, but a fund is more diverse.
It is. So it's not only diverse, it lowers your risk, right? Because you're spread across multiple properties instead of investing in just one single asset. Quality diversification is my favorite part because you can diversify across investments, operators, geography, size, asset class, asset type. Real estate is my true love anyway. I always tell people, and I joke about it all the time, there's like 99% of my own money is in real estate. The fund allowed us the opportunity to put everything into one place so that we could diversify across everything without investing in this asset over here, and then in this asset over here, and then in this asset over here. We just got to put our money into one place and it diversifies across everything that's in that fund.
Oftentimes investing in a fund, it's a question of compared to everything else. So just talk to us about some of those other asset classes.
Stocks and crypto. I'm not personally a fan at all, but Flip, my husband, does like to play around with it, but he's constantly on his phone going, hey, oh, I lost money. Oh, I lost a lot of money. And sometimes he won't even tell me at all. It's just a big joke.
It's the old buy the dip. Oh, and it keeps dipping.
He actually said that. Should I buy now? I said, why not? Go ahead and buy some more. He goes, oh, it went down again. And so we just joke about that. So very volatile. CDs, bonds, savings account are another, investment vehicle that people have. But in my opinion, those are just terrible returns. With the inflationary environment that we're in right now, you're just losing money every single day. So again, I'm always looking for those safe and reliable vehicles where I've got some certainty and higher returns that are outpacing inflation. And then we all invest in single family residences. Lots of people also love short-term rentals. It's very popular right now. For me, again, I don't feel like these are diversified. It's one single asset, one single roof, and it just adds a higher level of risk because it's one door as opposed to thousands of doors.
Yes, stocks have those 5 simultaneous drags of inflation, emotion, taxes, fees, and volatility.
So you've got on one side the profitability of higher returns, the certainty of the fixed rates, the security of it being backed by a hard asset. But then on the other side, you've got the emotional roller coaster of, the stocks and crypto and the possible financial loss of all of that being volatile. And then the low returns of CDs and bonds. So looking at the two and comparing them, it's just a hands down no-brainer for me.
Now, we think about a fund or any investment. I think it makes sense to look at it through the lens of risk versus reward. So first, tell us about fund benefits.
There's lots of benefits that we are even now exploring because we are getting ready to launch. We already have a fund that is available. In fact, you're invested in it, as you mentioned. Yeah. So thank you. We love having you as an investor partner. So we have that fund and we saw the popularity of it. All of our private lenders saying, hey, now my money gets to work for me 24/7 instead of going in and out of deals. So they just fell in love with it. And I said, okay, how can we do this on a bigger level? Instead of doing syndication, where you're going in and out of every single deal, now we just have multiple assets in the fund. So we started exploring what else can we do with the fund. And here's just some of them. And there's a lot. For instance, liquidity. We're going to have a fund that offers liquidity. So if you're like me, you probably have an account that has reserves. It probably has liquidity for banks. When we went and got a loan on our newest 48 unit, we had to have $500,000 that was just sitting there. It's not earning any interest where it's sitting. And so I would like to have this money in a liquidity fund where I can get it out pretty easily, but it's still earning some interest on it. So that's one of the things that we're creating. Another one we're creating is a $100 million fund. Right now, we've got over 600 doors. Those 600 doors, instead of being in separate, offerings, they'll be all in one. So it gives everybody the opportunity to, again, diversify across all of those investments and costs. They're all different operators. They're different geographical locations, different size. So that's really exciting. And what we're going to do with the fund, for example, we have a property, a 384 unit in Florida right now that is on the market to sell because we've hit the pro forma in under 12 months. So
Great.
We're getting ready to sell that property. So the investors in that are going to be cashed out. In the fund, you don't have to be cashed out. You get to keep your money in there because there's other assets still performing. So that's super exciting. And we're going to put a 3 to 5 year term on it and then allow you to say, I would like out at this point in time, or every year after you can exit. And that's totally okay. Most of the time, I would say over 90% of our investors, they never want out. They want to stay in there. So we feel like it's unlikely that people will want out, but they'll have the flexibility to do so. And we thought that option would give people, again, some certainty of where their funds are and the ability to be able to get them out of the fund at any given time.
With the 384 unit apartment building in Florida, once you sell that, then the investor has the option to get out potentially, or they can just stay in and keep their money working on something because they are in a fund where they have exposure to more than one property. And that way their money stays working. Like you said, you have about a 90% retention rate. And Danny Lynn, as I've worked with you over time, I've really seen you listen to investor feedback. For example, you have short-term funds for liquidity because oftentimes liquidity might be more important to an investor. And then you also have these long-term funds to preserve wealth and still get cash flow if desired over there. So you listen to your investors.
Yes, I think that's the most important thing we can do, right? To continue to grow and continue to serve is to hear what we're doing right. And on the other hand, what are we doing wrong? So all of that we take in and we listen to. One of the things that we have learned is that people really love, so in a syndication, people are accustomed to sometimes a high rate of return and no equity, and sometimes a low rate of return and equity. And so what we did is we talked to our investors and said, what do you like? What are you wanting to see? And they said, especially in this coming market, they prefer the certainty of the higher return. And some of them said, I don't need equity at all. I just like that 12% return that you're giving me. Just keep on doing that. So in the fund, we're actually going to keep that high rate of return, but we're also going to give them a little, upside. And we haven't decided if it's going to be two separate classes you can choose between the two, or it's just offered to everybody. So that's something we're still playing with. And we've asked our investors, what do you want? So we always like to listen to them. The other thing you mentioned is about cash flow. So this is a really cool thing. Compound interest. It's something that you can offer in a fund. As an example, $100,000. If you invested $100,000 in our 384 unit, for example, and we gave you a 12% simple interest return at the end of 5 years, your $100,000 would have turned into $160,000.
Okay, and that's just simple math. A 12% return times 5 years turns $100K into $160K, a simple interest return.
Exactly. Then if we would allowed you to compound it annually, that same $100,000 would now turn into a little over $176,000, adding an extra $16,200-ish if you compounded annually. Then what we're going to do in our fund is allow people to compound monthly. So that means that same $100,000 is now going to turn in after 5 years to $181,000. So an extra $21,600-ish is the extra returns that they're getting because we're allowing them to compound. Now, the only caveat to this is they have to choose that at the very beginning. When they give us that, those funds, they have to say, I do not want distributions. I want it to go back in and I want it to compound. Or they can choose, I want the monthly cash flow. I like the check. Or they can say, I've got $1 million. I want $500,000 giving me cash flow. I want $500,000 compounded.
Simple interest being where your principal amount earns interest, and compound interest being where both your principal and interest earn interest. Danny talked about the possibility of compounding monthly. And let's talk about those returns, because I know you offer up to 12% preferred returns. Tell us about what that means.
Yeah, so preferred returns means that you get paid before we get paid. Again, I'm always watching out for the safety of the investor. What can we do to make you feel certain, safe, secure? This is consistent, this is reliable. And if I am going to put in all the work and ensure that you get your money first before I get it, you can almost guarantee, or pretty much guarantee, you're going to get your money, because I'm not working for free. So that's what a preferred return is.
A preferred return, you as an investor get a return up to 12%. And it isn't until your cup runneth over with anything additional above that anything would flow to the sponsor of the deal, Danny in this case.
That's correct. Yeah. And I feel like that really aligns our interests. And I'm an LP too, and LP stands for limited partner. So I don't even just sit on the general partner side. I also sit on the limited partner side. So it's my money just like it's everybody else's money. So I like that win-win scenario in vehicles like this.
Danny Lynn, it's funny. I think an even worse term than some of those, 4-letter words I was joking about earlier that really aren't bad words is maybe fixed income. Oftentimes you think about, maybe a person that doesn't work anymore and they're only on Social Security. But in a sense here, you offer fixed income returns that are pretty high.
Yeah, it is. And again, that came from the feedback we got from our investors that I would prefer the certainty of this high return than a 6% return with upside. And I have to hope that you actually do a good job and get that upside for me to get that, windfall. And every investor is just a little bit different, but the investors that we're working with for some reason are just, hey, give me that 10 or 12 double-digit return and I'm with you all the way. So we're trying to create that win of being able to do a little bit of both.
Tell me more about that word certainty, because with a lot of the economic headwinds that are coming, certainty seems to be a more important word to a lot of investors.
It is. And we have written down up when we're talking about this fund, our team has written down 4 words that we're focused on. It's safety, certainty, reliability, and growth. Those are the 4 things that we want to make sure that we're hitting for our investors so that they feel good about the investment, because we are going into an uncertain time. And fortunately, we've been in real estate long enough that we've seen the ups and downs, so we know how to navigate and pivot. And so we've already done some of those moves. And even one of our investor relations team members said, Danny, I've been worried about this market. And all of a sudden you ping me and say, hey, we're proactively going to make these changes because of the market we're going into. And he said, I invest with you and I'm also on your investor relations team. And that just makes me feel so good. So I think that's why those 4 words are so important to me, because I think it's top of mind for our investors as well.
We're talking with Danny Lynn Robeson of Freedom Capital Investments. Why do I choose to invest with her? And what are the risks? And what are the tax benefits? And more. That's straight ahead. You're listening to Get Rich Education. I'm your host, Keith Weinhold.
Americans are not saving for retirement. It's going to get worse as people live longer, so you need to think differently, but you can't lose your time. Real estate is the investment vehicle that has created more million and billionaires than anything else. Get Rich Education is one of America's top investing shows disrupting Wall Street. Your host, Keith Weinhold, is a true financial educator and has been an income property investor since 2002. Get Rich Education has created millions in passive monthly income for its followers. Now, Keith is a free course. Real estate pays 5 ways. Sign up now at getricheducation.com/course. Invest in what produces income for you now and later. Use the link in the description to take the course for free. Real estate pays 5 ways. Get Rich Education is on every podcasting platform and has its own native iOS and Android apps. Join Get Rich Education Nation to create financial freedom through real estate investing. Subscribe wherever you listen.
Hey, welcome back to GRE. We're talking about fund investing today with the person whom I've trusted with my fund dollars, Danny Lynn Robeson of Freedom Capital Investments. You can learn more at gremarketplace.com/funds. Danny, let's talk about your track record, because you do have a track record from investing on both the equity side and the debt side and more in real estate.
Absolutely. So my husband and I have been in the real estate industry since 2008. What a crazy time to get involved. But that does mean we have the experience of these cycles. And that's been fantastic. We moved to Ohio, though, in 2015, built the 6 companies that we own now today, hired a CEO who's running most of them as we build out Freedom Capital Investments, because I just love, the building process and really hearing from investors to see what's going to meet their needs and how can I help do that. I would say since 2008, we always are trying to figure out the number of deals, but it's like over 1,200 deals. A lot of that heavy in the single family, 1 to 4 multifamily space. But now we are part of over 600 multifamily deals, and we're building some self-storage partnerships. So we've been doing this for a very, very long time. And we actively use, I would say, upwards of $10 million, even within private money lending, syndications, things like that. And it's just continuing to grow.
Yeah, you're doing quite a bit of volume. And, I think one reason that you've attracted the interest from so many investors is the way that you mitigate risk with your audit. Tell us about that.
Yes. So safety for the investors is like top of mind always. And as you get into these bigger vehicles to invest in that do so many different things that we've talked about already, like especially the compound interest and the deals, maybe this 384 unit sells and it's inside the fund. What happens to that and the profit that goes back into the fund? How does that get distributed? Well, we hired a fund manager that manages billions of dollars of assets under management. They've been in the industry for years. They do not advertise. They are by referral only. Their retention rate is over 90% of people who stay with them. So we hired them to be a third set of eyes to run all the financials. They manage our web portal. They provide the reports. They're available to investors to jump on the phone to ask questions for anything that they have. And then as a secondary piece, we actually have hired a different third party to do annual financial audits on their financials, so that now we've got full transparency in 2 different ways. We're not even doing it anymore. We've got a third party managing it, and then we have somebody else auditing it. And again, it's just to bring that safety to and peace of mind, quite frankly, to me, probably first, that we're doing right by our investors, but also for our investors.
Tell us about the tax benefits associated with this. Sometimes people aren't aware of how beneficial some of those are with fund investing.
Absolutely. So you, of course, have the straight line depreciation, and then you have bonus depreciation, which is my favorite, even though it's going to be going down bit by bit over the next few years. But that bonus depreciation is when we get out there and have a cost segregation study done, and they bring back this report of how much extra depreciation we can take in year 1, which again passes down to our investors. So we all get, some really good write-offs there in year 1. And so you've got those. And then I believe it's 2023, it's going down to 80% of that is going to be allowed to be taken as depreciation, and it keeps on going. Some of our properties are even going to be long-term holds. So I talked to my CPA and I said, hey, I just want to confirm I understand how this is going to affect depreciation, because usually you get this big bonus depreciation, and then when you sell the property, you have depreciation recapture. I said, so if we're going to have a long-term hold, does that mean when we refinance, they don't have depreciation recapture, and for 10, maybe 15, 20 years, they don't have to experience that depreciation recapture. They just get the benefits of the loss. And he said, you nailed it, Danny. And I was like, yes, okay, more long-term holds.
All right. Bonus depreciation, accelerating the number of write-offs that you can obtain, which is something you may or may not be doing if you're an individual investor buying a single rental property.
Correct. Yes, you nailed it. I figured you would probably be able to explain it even easier and simpler than I did.
Well, one thing that really interests investors are a lot of the things we covered, like the returns, the reward, and the risks. It makes some wonder, now, what are the minimum dollar amounts in order to get involved? And then must I be accredited?
Yes, so that's a great question. We are going to have multiple funds. The liquidity fund, we are aiming at trying to make it $1,000. Very, very simple for people to come in and say, hey, let's test out this Danny person that has been on Keith's podcast. Let me just see how she does. So that's one idea. We're working on it. It is a very small amount of money. So we're talking to the fund manager and asking him how it's going to work. But that's one. And then the other ones are probably going to be 50,000 and 100,000. Those are the interval levels that I think that we're going to have, at least that we're working on right now. And we're going to have a mix of accredited versus non-accredited options. A lot of everything that I'm talking about today is for accredited investors only. And that's because I'm not allowed to talk about the ones that I allow non-accredited investors into. That has to be a relationship. We have to have talked to you. And as soon as we've talked to you and had that conversation, you get to hear about everything that we're doing, which includes opportunities for non-accredited investors.
The SEC, the Securities and Exchange Commission, does have some rules about how one can advertise and what one can talk about and when they can talk about it and when they cannot. So Danny is just adhering to that part of the regulations there. Well, Danny, before I ask you how our viewers and listeners can learn more, do you have any last thing that a potential fund investor should know? Maybe something that I did not think about asking you?
I would just say, I love that you talked about the track record. I think that's most important is the who you invest with means the world, because I can't tell you how many times I do get on the phone and I hear stories about people investing with other people and what happened. And so they ask me all of the hard questions, which they didn't know to ask the first time around before they got hurt. So knowing who you're investing with, what is their track record, where are they located? Can you go see their office? Can you see the buildings that they're investing in? What is their success rate? Ask what's your worst deal. And I freely tell people, what my worst deal is, because that matters, right? Did you pay your private lenders back? Did you still, did people get their same returns, or did you have to negotiate it? And I like answering those questions because they're important to me, because we always put our investors first. We'll lose money, but we do not want our investors to lose money. And so I think that track record piece, you nailed it.
Tell us about your worst deal.
Yeah, so it was a duplex in Dayton, and we lost $40,000. We had hired a project manager, and the project manager was running out of time to check all the properties. And so the contractor was invoicing us for a finished bathroom, for a finished roof, for a finished whatever. We were paying for the contractors because we have a great reputation here in this area. And contractors, flood to us because we pay them every week on time. Well, this particular contractor was just pulling the wool over everybody's eyes, taking pictures of certain things that were finished in the picture, but you couldn't see the rest of everything in that room. And so we had paid out a bunch of money for a property that was not yet done. So in the end, it was somewhere between $40,000 and $50,000 that we lost on that property. We finished the rehab. It still sold to one of our investors. Our private lender got 100% of their capital back, did not have to give us more money. When we lost it, we just got it out of our own back pocket and, put it into the deal. They got paid all of their interest that they were owed. In fact, we joke about the fact that we didn't even tell them, not that we weren't being transparent, but they didn't need to know. We were going to pay them and all of their interest, and they didn't have to be worried about the fact that, hey, that something bad happened. They just trust us to provide them a return and get their money back. So that was our worst deal, and that was painful. We make sure to always walk our properties before paying contractors now.
Yeah, so that's great that you're transparent enough to share your worst deal. And you did share with me before that even when you have made a deal that wasn't that good, your investors didn't lose out. They still got paid.
That's right. I think that's one of the risks as an investor. If you're going to be an active investor, you have to know that not every deal is going to be a good deal. There's going to be a certain percentage of deals you're going to walk in and do the very best job that you can, but there's something behind the wall. There's something that you did not see that is going to tank the deal. And that's just the reality of real estate. And so I tell people I got into volume for a reason, because if I'm doing volume, it's okay if 1 out of 10 or 2 out of 10 ends up being a bad deal. I've set my expectations that I am in real estate and I understand the risk that I'm taking, but I'm going to mitigate it by doing a lot of deals so that 8 or 9 out of that 10 does end up being a good deal so that I can ultimately sustain that profitability.
Yeah, your diligence sure has created good returns for investors, and that includes me. Well, Danny, if someone wants to learn more, I know you put together a free report.
I did. So it's funds versus syndication. And the reason that we put that report together is because a lot of people are very familiar with syndications, but the word fund and funds in general is a new concept. So we wanted to show the difference between the two and how, in our opinion, funds give you, again, better diversification with the certainty and reliability of a fixed rate of return backed by that tangible asset.
Yeah, if you want to learn more and get that report, you can get started again at gremarketplace.com/funds. And then, Danny, what if someone wants to reach out directly to you?
Absolutely. So you can call us at 937-551-2282, or you can email us at invest@freedomcapitalinvestments.com. You will go to my team initially, but I was just having a back and forth exchange with one of our investors who emailed that invest box. Just so you know, I get in there too because my assistant Jody goes, "Hey, Danny, there's something for you in that box," and I'll run in there and I'll answer it. And so I'm here and available for anybody if you need me.
Danny Lynn, it's been educational. Thanks so much for helping us learn more about funds here on the show today.
Thank you so much, Keith. I really appreciate you having me.